Welcome to the Common Sense Investing, or CSI Show, with Victor McClure and Guy Allard from McClure Capital Wealth Management Companies. For the next hour, Victor and Guy will use their combined 60-plus years of experience to answer your financial questions with their own brand of plain-spoken language and hard-hitting style.
Welcome to the Common Sense Investing Show. I'm Victor McClure.
And I'm Guy Allard, and you are cordially welcome to the last show of 2018. Hopefully, Victor and I have not been anywhere near as volatile as the stock market has. Holy
It is going crazy.
Ow.
What did it do? Christmas Eve, it was down, 500-600 points. And then the day after Christmas, it was up 1,000. And then it opened down... 500, 400 on
600, I think it got to on Thursday.
And then right before the close, the last hour, it was up 250 points. Holy moly. This is not for the weak need, I'm telling you that.
That's exactly what I was just thinking. Hope everyone had a great set of holidays, whichever they were, and whatever you were hoping to get, that you were able to get. I know it's the season of giving. And I'm about gived out. How about you, Vic?
Well, when you have 4 kids, you'll end up spending several $1,000s on Christmas presents. Usually you get some Old Spice or something like that. And I'm like, hey, what is this?
Right.
I'm one of those people that pretty much, if I wanted it, I already have it.
Yeah.
And so it's really hard to shop for me. But not that they shopped anyway for me. My daughter always gives me some real nice handmade. So she's the only sweet one I've got.
I wish there was a nice way just to tell folks, a nice card or something. We could exchange cards and a nice thought. We had a great year, and thanks for the memories.
Will that work on your wife?
And all, well, no, wife's excluded. Now, I wasn't talking about my wife. I'm talking about the 15 other gifts I got that apparently some advertising company had given them, and they re-gifted to me. Some Bluetooth little 2x2-inch speaker that's wireless for your cell phone. And of course, you and I have got the big monster Bluetooth deals, and it's got the promotional company's name on it. Now, he didn't go out shopping for that. It was just I'll give this to Guy.
Are you saying regifting is wrong?
Oh, no, well, I've actually regifted. And some of the gifts we got this year, I'm just saying, may be regifted.
I'll tell you what, it's funny when my...
and I'm not talking about fruitcake.
No. If you're shopping for your wife or whatever, I'd always get something and she'd hate it. I can return it, whatever. So I said, this year, this was a couple of years ago. You know what I'm going to do? I'm just going to give her money.
Oh, yeah.
So I'll put just cash in the
deal,
right?
uncaring.
Oh, you didn't care. You didn't put any time.
You thought into it. Yeah, that's right.
So this year,
that's right.
I bought some stuff knowing she's going to return it, but have a shopping spree at these stores, right?
Right.
Nope. I can't believe you didn't just give me cash or a gift card. Wait, I thought that was unthoughtful.
Oh, I know it.
Now I got to drive to North Park to get the thing.
I've tried everything. Years ago, 6, 7, 8, 9, 10 years ago, didn't know what to get. Can't really buy them clothes, right, or shoes, because that's their own thing. And I don't want them buying me clothes. Reminds me of when we first met, getting a pair of salmon-colored corduroy shorts, which I never wore, but that's another story.
Ooh, that's
I know. It was
bad.
Really? Did you not know me? But anyway, so one year, years ago, I said, you know what? I'll go to the spa, the Cooper Center clinic, and bought her a whole day's worth of, whatever she wanted to do, and a dinner, and probably was a birthday, and a bag with all the tissue paper, and nope, didn't want it. That's not what she wanted. She wanted the cash. Took it back.
I've tried that. You ever tried to get a gift, and I tried to get the little paper.
Yeah.
Put it in there, fluff it like they do at the store.
Oh, yeah.
It looks like crap.
I think the ribbons look good.
Looks like I wadded it up. They'll do something with the scissors and make a little doily
That's
thing.
right.
I was like, oh.
That's right.
Yeah, mine didn't turn out so good. So, well. Well, Christmas is fantastic.
It was a good time. Good time for family.
Relatives come over the house. Had the little kids over, and I forget what it's like to have toddlers. Holy moly, I'm too old for that.
I heard a good cell phone story at your house over the holidays.
Yeah, they just thought it would be funny to grab cell phones and throw them off the loft.
They went
on the hardwood floors.
They ran them upstairs and threw them down on the hardwood floors.
Great.
Did any of them completely break?
None of them broke. I can't believe it. I said, grab the cell phones, grab the iPads, put them into the closet.
Lock them up.
Lock them all up. I had to put everything up. I'm like, there's no telling what's going to be flying around here. Oh, they haven't figured out those door lock things that I put on the door so they don't go in the backyard and drown in the pool.
Right.
They haven't figured those out yet. They will eventually.
That's a good deal.
They can't spin them. So
we love having our nephews and nieces over, and when they were kids, I'd take them to the park and play basketball with them, and we'd wrestle, and I'd do the Vulcan death grip on them from Star Trek, and giggle, and they'd sleep over. Now they're older, right? They're in their mid-30s, and they have kids, and love having them over. They're in the pool swimming, in the jacuzzi. They like the jacuzzi the best, right? They're in and out all Friday evening and dinner, awesome. Saturday, all day, awesome. Sunday, I'm in the garage Sunday, hiding at my desk, and they're at the computer. And son of a gun, if they don't find me and jump on my lap and take over the computer, you just can't hide.
I know. I'll be looking at my iPad and just, well, what'd you do to it? All right, but that's, they say I love my relatives, but it's weird. I see them like once a year.
Yeah.
I guess I should see them more, but that's me, maybe. I don't know.
It's anyone, no matter how much you love them. After 3 days, you're just used to your own routine. You don't love them any less.
Right.
You just need your own space, right?
I was thinking about...
It's the same thing what they think about us, right? When we go visit them, it's like, all right, dude, 3 days, time you should go home.
I figured I could, make an emergency trip. Oh, my gosh, I got a client in Florida that I have to go see. I'd be like, wait, do you have any clients in Florida? Never mind. It's my biggest client in Florida. I got to get out of here. All right, well, the stock market, we've been saying it for weeks, if not months. There's a million different things. You say, okay, it's the trade tariffs with China. It's the rising interest rates. It's the geopolitical turmoil. It's something new every day. I honestly believe the reason why the market's getting so volatile is it went up for almost 10 years in a row. And that's what it does when it corrects.
I think it's an amalgam or a mosaic, whichever word you want to use, of a lot of things. There's certainly, you and I were talking about it at lunch earlier this week, a good argument on Jay Powell. There was an economics professor, and as Vic told me at lunch, he said, well, you can find one that'll say anything, and that's true. Right. You can find 10 that'll have exact opposite opinions. But he said here, what Powell's doing reminds him of a first-year macroeconomics student that he would have as far as what he's trying to do. When you raise interest rates, right, you're raising the short-term side of the yield curve. It doesn't automatically translate to raising long-term bonds, which is what you want. And if you don't, you've heard about it over and over again. Right now, we've pretty much got a flat yield curve, meaning why invest in 30 years when 10 years will pay you, under 0.2% lower than what a 30-year bond will. Next thing is an inverted curve. And part of the things this economic professor brought out, and he's one of the talking heads that's well respected, and again, you can find both sides of the story, but he said you just can't do it. I mean, you look at foreign rates, you look at foreign money here, and just by raising the front end of the yield curve, the short-term money does not automatically translate to the long-term's moving. And you can see that in the last several moves, it's done nothing to long-term bonds.
I think we've had this flatter yield curve for a lot of years. I get it. It used to work.
Do you think that's a new norm?
It could be. I mean, it's been at least 10 years.
It's been a long time,
flat
right?
yield curve, or not
close enough.
Think about it. In the old days, when you raised the short-term yield curve, right, you got to raise the long-term, and who's going to risk money for 10 to 30 years when they get the same thing for 2? Nobody would, right? So therefore, the yield goes up, price goes down, whatever you want to call it, and that's what it's supposed to do. But it hasn't done it in a long time. They'll definitely get up your short yield curves. I mean, your mortgages, though. You ever notice that? Actually, 30-year rates aren't that much different than short-term rates, but they should raise that mortgage every time, right?
I tell you what, the credit card rates I don't care if you've got an 850 score. If you carry money on the credit cards, they kill you at those rates nowadays.
I told you that's why credit card companies, banks are part of my axis of evil. They'll give you 0.1% on your money market, but charge you 20% on a credit card. If you're late on one card, you just let you go on vacation for a month, and you forget the other cards can raise you even though you never missed a payment on those cards. Just 30%.
Since we're goofing off here a little bit, there was another economist that was on. He was talking about the lotto. And we all know that the odds are terrible in winning the lotto, and they've increased them so that the amounts would get bigger, right? I've talked about my favorite bumper sticker, lotto, a tax on people who are bad at math. He went on to say that it would be illegal, that no government anywhere on the planet would allow any casino to have any sort of game that had any odds anywhere near as poor as what a lottery is. Yeah, so that's a reminder.
No, that's true. But the stock market can't go up forever. And I'll tell all you real estate folks out there, the real estate market can't go up forever either.
There you go.
And so you're starting to see inventories rise, prices not going up slower. You're going to
Rates are rising, hurts them.
There'll be a time for those too. We got a break coming up, folks. Stay with us. If you have any questions, financial questions or anything else, call us at 972-715-2424. Again, 972-715-2424. Don't forget to go to our website, ilovemyretirement.com. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, where your investment strategy is always based on facts instead of some sales pitch. Here's Victor McClure and Guy Allard.
Welcome back to the show. Well, the market hasn't finished this year. It's close, right? It's close. It hasn't finished. But if it holds around here, you're looking at about maybe a 7% loss for the year. Now, remember, the market is still up over, I think, 20% from the election. So if that's the case, don't worry about getting your stuff in order. In other words, getting down to where you should only have your age is how much you should have safe, right? So the difference is what you could have at risk. And so use that. Don't try to get those back in order, because what has happened is your safe money hasn't made crap for years, but your market money's made a lot. So even if you had a good balanced portfolio 3 years ago, 2 years ago, it's not balanced now. So go ahead and do that, and don't worry about what it's made or lost the last few months, because you're locking in a pretty good profit there. And if you always did this, 2008 didn't affect you very much. 2000 to 2002, don't get me wrong, it wasn't fun. Nobody likes a 50% down market.
But it would only be in one of your three buckets.
That's right. And so you got to rebalance that stuff. You have to do it. There's people go one way or the other. They either say everything should be stocked at all times or nothing should be stocked.
It's kind of like politics nowadays, right? It's polar opposites. There's nothing, and then there's no middle of the road anymore.
Two things.
I'll add on that note, and the three bucket theory that we go through, Victor and I, as we close segments, we always say if you have any questions, call us. We're happy to answer them. We throw out our number, 972-715-2424. But good questions to ask, ones that we really enjoy digging into you, is if you want to quote, how long will my money last? This is what I need monthly now. What will that be in through retirement? This is what I have saved. This is how my alignment of my three buckets are, cash-wise, income-wise, versus income needed, how much I have in my stock, and here's my age. They're real easy for us because we do it every single day. So if you want to quote and you've got some questions about when you're going to run out of money, what adjustments can you make, all that good stuff, that's fun for us. Call us, 972-715-2424, and we'll crank out the numbers for you.
Absolutely. Again, 972-715-2424. I want to talk today about income. There's the old saying, money's only worth what you can buy with it, right? In other words, I think my dad used to buy brand new Cadillacs for $7,000. Well, they're not $7,000 anymore, right? So that's called inflation, obviously. In retirement, your retirement's for most of us. If you're really wealthy, obviously income's not an issue. But for most people, your retirement savings, whether that's IRAs, 401ks, or non-IRAs, 401ks, it's how much income you can get from it. In other words, you're going to need, unless you can live on Social Security, which most people can't. So we're trying to figure out the 90% people, right?
Right.
90% can't live on Social Security. They need some more income to supplement Social Security and or pensions from retirement accounts. Remember, it was a 4% rule. You take out 4% of whatever you got. So $1 million, you take out 40, and you can increase it for inflation every year. Okay. The problem is when they came out with that rule, it was actually a California financial planner came out with it, and the academics confirmed and reconfirmed it so many times they couldn't believe a financial planner came up with it. It had to be an egghead, not them.
Right.
But he did. But they had never experienced interest rates this low. And so they redid it at the same information, just put in current rates increasing back to an average or a mean, right? They redid it and came out with 2.8% is the most you could ever take out. So I got $1 million, $28,000 a year. All that's fine and dandy. The problem is,
if you live in 1950, you know what I'm saying?
I mean, if you can live on $28,000 a year per million, then you're probably okay. You probably don't have to make too many adjustments. And if you've got the stomach to all stocks, you can do that. But most people can't. It's just like most people can't live on just Social Security. They need some supplement. But $28,000 per million is not a lot. Now, even if you did that rule, I actually ran the numbers for this century. The 4% rule didn't work. You're almost broke. And half of the time, the 4% rule gave you a 90% chance of not running out of money in 30 years. Because they're saying a standard retirement, 60 to 90.
Right.
Even though your family, nobody's lived past 85, when you're a married couple, there's a really good chance one of you gets to 92. So you really need that 30-year time frame because you never know. Remember, 30 years ago, a man's life expectancy, I think, was like 20, 30% lower than it is now. So it's going up. And as with computers, it goes up exponentially as we get older, right? So I don't know what it's going to be when I'm 80, 90 years old. So you got to plan for a long life, in other words. The problem is it didn't work. The 4% didn't work. 2.8 would have worked. You're still down quite a bit. And so it's in danger of losing. So
how many years did it work for?
Your money's almost gone. 80-something% gone in 17 years. 18
for
years.
This century.
Yep.
Got it.
If you got 100% of the S&P without a fee, which is impossible.
And dividends.
If you had a 50-50 portfolio and all that kind of stuff, you're probably out. It didn't work anymore. So what do you do when it's out? Well, that's what I want to discuss today is what can you get income-wise from things, and how do you compare them to see what's right for you and your family. A lot of people know that you can always get a CD. A lot of people know you can get a bond. You can get an annuity. There's a lot of different things you can get, but let's go over rates for these particular ones and the pros and cons of each. But we got a break coming up. Remember, if you have any financial questions, like to take advantage of our no-cost, no-obligation portfolio review, retirement stress test, Social Security optimizer, don't hesitate to call our hotline. It's 972-715-2424. Again, 972-715-2424. You can always go to our website, ilovemyretirement.com. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080, KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Oh, I did have somebody, Guy.
Yes, sir.
They asked me who was that older guy on the radio with you. I really like him.
And, of course, you told them that was me.
Yeah, we've known each other 30 years. We're about the same age.
It took the third segment, Sarah. This is our engineer. Sarah and I had a little side bet. You lost for her to bring up age.
And they said, well, he's got an older voice. I go, we're the same age. He's not old.
Hey, we were getting ready to go through different rates, short-term things, safe things, guaranteed things. And as far as money market accounts go, I had a dear clients, his live-in girlfriend's also his accountant, which usually works out very nicely. And I was mentioning to them that I got some advertisement. We're not affiliated. We don't get any kickbacks, but I got some advertising in from American Express, Amex. And for a liquid money account, it's an internet-based account, they're paying 1.9 or 1.99, which I thought was pretty good. You're not tied up. You've got complete access. And the client's wife reminded me of remember the old ING Orange account?
Yep.
That paid really high during the mid to late 90s. Yeah. When they were first up and coming. Well, ING was purchased out by Voya, VOYA. And it's now Voya. You can look it up. If you're looking for short-term rates, it's not local, but, you still can access it. They're paying 2%. We were talking about the yield curve. That's 2% for no restrictions on your money. At 10 years, 2.7, 30 years or what, 3 something. So it's pretty flat. But anyway,
no, that's not bad.
Just some thoughts for you
I think
if you're
Chase
open
has one
to.
too, and Capital One has one.
Yep.
You got to have a certain amount in there and all that. Just look at the restrictions. None of them are typically not brick and mortar type. They're usually internet based.
That's right.
I'm a little leery on internet banks, even though I shouldn't be. I guess.
Same thing on the CDs, right?
Yeah, I'm just a little, because I looked at Bankrate.com, and that's a good source, by the way, to get money market CD rates. But Bankrate.com, and we're not affiliated with them either.
No.
We need to start getting them to pay us, right?
Yes.
But it's a good place to find CD rates.
You know, it's funny. I'm still a little leery of the internet after all these years. I do, as I'm sure you do, all of my online banking and bill pay, and I've had a couple hiccups with credit cards and accounts. I know you have in the past, and you never lose anything as a hiccup, and you get your money back. But I still won't do the iPhone or the Android phone wallet, you know, where everything is on that phone, and you just tap and you swipe, and I'm a little nervous in that still.
Oh, I got my smart-ass neighbor that every time I get my newspaper.
Yep.
How's that paper, Grandpa? I go, it's nice. I can read the thing and hold it in my hand. I can't even read that iPad thing. Is good. Apparently, me and the guy across the street that's about 75
Are the only two that get an actual copy of the paper?
Yeah, like, what is that? But that is. All right, let's talk about what rates you can get and what you use them for. All right. Treasuries, U.S. Treasuries are considered the safest thing in the world. You know, some people might argue that fact, but they're backed by the full faith of the U.S. government. Some might argue that's not as good, but historically, it's never lost. And even the biggest countries on the planet invest more than anyone else in our treasuries. Everybody goes, well, what if they had to pay them back? Well, we just say no. Like in China, I want to call all these bonds. Well, that's a 10-year bond. You're not getting it.
Can I have a
what
little
if they
time?
quit buying it? I go, well, somebody else will buy it. People realize they have to buy those things. You can't, when you're talking about so much money,
Yep.
you can't own California. There's just too much hassle there or whatever. That's how much money they have to. So they invest in U.S. Treasuries because really they have to. There's nothing big enough to allow them to put billions of dollars at a time on.
One of the obligations of having a lot of money is placing it properly.
So we're talking about the flattening of the yield curve. U.S. Treasuries 3 months are paying 2.425. 2 years paying 2.562. Now you got to ask yourself, would I tie something up for 2 years versus 3 months for less than 0.1%? Okay, then you go into 5 year at 2.608. For less than 0.2%, would you tie something up 5 years versus 3 months? Excuse me, I got.
And especially right now, the market is extremely volatile. We just talked about earlier in the show, 1,080 points on Wednesday of this week.
Oh.
And then Thursday, the market started down 600. So it seems like with this type of volatility, tie up your money for any length of time, so much can happen right now. Politically, you know, it's so the polar opposites of both political parties. It's very difficult.
10-year treasuries are 2.751, and 30-year treasuries are 3.009. Now, I'm telling you, I would have to be on dope to buy a 30-year 3.009 treasury when I can get 2.5 for 3 months.
Or
Really?
yeah.
Who would buy? But apparently they still buy them. Remember they came out with a 30-year just a couple of years ago again. They took it out for a long time. And then the rates have been terrible, so who's buying that crap? I don't know. We got a break coming up. We'll get through this when we get back. Remember, if you have any questions about anything at all, call us at 972-715-2424. If you'd like to schedule a meeting in our office or just like to chat, 972-715-2424. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome to the Common Sense Investing Show, the home of plain-spoken, no-nonsense answers to your financial questions.
That's right. Plain spoken, no nonsense. That's the only way I know how to talk anyway. So.
That's right. Apparently you and the president. Take
Not
that.
that I can talk way up there anyway, right?
That's
All
right.
right. Well, we're talking about treasuries are paying 2.425 for 3 months, and 30-year only pays you 0.5% more.
Crazy.
Yes. So I would stay away from all long-term stuff, by the way. But now let's go corporate bonds. Corporate bonds are in the same flat yield curve. I can get 4% for AAA corporates on a 5 year But a 10-year only gives me 4.2.
Yep.
Doesn't make any sense to me why I would do a 10-year, right?
Right.
And so let's do CDs. CDs, 2.8 on the 1 year. Now, these are internet bank rates. Don't go to Bank of America and ask for that because you know they're not going to get it.
Yeah, you won't get it.
2 year, 2.9, 3 years. The highest one in the country is 3.5. That's another internet bank. But they average on the high side, 3.15 to 3.5. That's not much difference between a 5 year and a 1 year. I'd stick with 1 years again.
Yeah, and be careful not to try to trick the system. All of us like to do research, whether you're buying a car or a pair of shoes or whatever it is, and we want to get the best. The problem with investments, people start shopping rates, and we've talked about that over and over and over again. There's many, many, many pitfalls. If it's a stock account, they can be using average versus actual rates of return. They can be using certain time periods. There's many different ways to do it. On fixed accounts and on bonds, and I've seen it personally with a couple of people who have come in, had questions. Oh, no, you don't understand. I have high yield bonds. My bonds are paying 6, 7, 7.5%. So you have to go through and remind them. You've heard us talk about it many a times. Unless you were going to get into this in a few minutes, which I'm pretty good at doing, just about as you're ready to get into it. High yield bonds are just perfuming the pig, if you will. It's junk bonds.
But lipstick on a pig.
Lipstick, that too. It's just they used to be called junk bonds, and there's a reason that they're giving a higher yield. They can't borrow money at these rates that Victor's talking about. No one will give them money at that. No. It's high risk.
You don't realize they're below investment grade, which is triple B and up. Not triple A, not double A. They're below triple B.
Our errors and omission insurance won't even cover us on those sorts of sales.
That's right. We use a company that's under investment grade. They won't cover us if we make a mistake or whatever. So that's got to tell you something. Stay away from that.
So the response I get, when you're trying to be helpful, and if someone's in something good, well, tell them this is good. Don't change it. Many people, I said, you've got surrender fees. Stay in it 6 months. Let's talk later. See what things look like. See what the visibility is then. But on these, the first thing I hear is, oh, no. But you don't understand. I'm getting 7%. And I said, well, you're getting 7 till you're not. I mean, they pay till they default. There's a reason.
We've been doing this 30-something years each, and we've seen them default a lot. And what happens is when you're in a lowering interest rate environment, they don't default as much because they can refinance for lower debt payments. But when you're in a rising interest rate environment like we have now, they can't refinance. They just default.
That's right.
And they will start defaulting exponentially if they keep raising these rates.
How many people did you warn about life settlement programs and unregistered?
Hopefully thousands.
Used to be viaticals. But how many people did they listen?
That's right. All they did is change the name. Viatical settlements turned into life settlements. They just changed the name. It was the same thing. Lost everybody's money again.
Yep.
It's just like junk bonds lost everybody's money. We can't. That's a terrible name. Let's call them high yield bonds.
It's analogous.
It's the exact same thing.
That's right.
The reason why, I've heard this a million times. People sell annuities because commission's high. Managed account over time is higher commission or
way more. Pay me way more money. That's right.
The real reason is 5-year rates. Now, these have gone up. These are higher than they've been in years.
That's right.
You're talking 2.6% on a government bond, 4% on a corporate bond. So why are annuities so popular? Because they pay more than those.
And
That's really the reason.
Fixed annuities here, not variable annuities.
Well, actually, I want to put on all of those kind of annuities to show you the difference. There was a big article, several pages long, it was a trade publication. But it was showing if you want the most income from an annuity, here's the 4 different types. And this is what we do every single day. What we'll do is we'll show you all the bond yields, treasury yields. You're welcome to doing those. And then when you show an income yield from an annuity, it's this much more. So remember, $1 million right now in bonds, CDs, money, probably $24,000 to $40,000 on the high side. And I don't want you to be 100% corporate, so you can't do that. It's too risky. So let's say $30,000 average, whatever. Okay. Well, right now, if you did it on the annuity side, right? Variable annuity right now, immediate income for a 65-year-old would be $5,600.
And a lot of fees.
So $56,000. I'm sorry, $1 million gives you $56,000, and a lot of fees. All right, your income would be still $56,000.
That's right.
It's just your cash value is going to eat up by that $56,000, and another 3 to 5% fees on top of that are coming out of your cash balance.
And it doesn't earn money during that period of time. That's all I'm going to say about that.
Then you got a fixed index annuity, $5,500, $100 less, or $55,000. I keep on per million.
Right.
And then you've got a SPIA. SPIA is single premium immediate annuity. Those are the type that you heard been around forever. You just give them your money, they give you an income. The bad part about it is you die, they keep your money. I'm not doing those. I can't do anything that keeps my money.
Yep.
Now, you can get some of the cash refund.
And it doesn't earn money.
Doesn't earn money, right?
Process.
And so it's about $5,800 for a woman, $6,000 for a man. So it's about $5,000 or $6,000. Well, that's better than $2,000 to $4,000 in a bond right now as far as income, if your objective is max income. Now, let's say when you defer it 5 years. That's why I tell people you got to come in before you retire because we can get you a lot more income. But let's say it's 5 years. Well, a variable annuity pays $7,500, $75,000 a year. These are the top ones. Fixed index annuity, $8,800 a year.
Oh.
So that's almost 9%, $88,000, I'm sorry. That's almost 9% of what you put in it if you defer it 5 years. SPIA, $8,000. SPIA is that single premium, the old-timey annuities. So think about it. Would you buy something that money's gone to get $8,000 a year, or your money's not gone for $8,800 a year? Right? Makes sense.
1,000.
1,000. I don't know why I keep saying
That's
88.
right.
The examples on this graph are per 100,000. I'm always doing things for a million. That's why.
I'm with you.
Now, the real gold mine is if you can defer 10 years. Doesn't matter if you retire in 5 years. You can defer income 10 years. The numbers are huge, and we're going to go
Don't tell them until we come back.
after the break. Stay with us, folks. You're listening to the Common Sense Investing Show on News Radio 1080 KRLD.
Welcome back to the Common Sense Investing Show, hosted by two of the most experienced advisors in the DFW Metroplex, Victor McClure and Guy Allard.
Welcome back to the show. Right before the break, we're talking about the real reason why annuities have been so popular the last 10 or 15 years. Has nothing to do with commission, has nothing to do with anything else except rates. Remember we just talked about. Now, the bond rates are significantly higher than they were 2 years ago, right now. And the best you're going to get is 2.4 to 4%. That's it. So you got $1 million, you're getting $24,000 to $40,000, and you can't have all of them in the corporate, so you're probably around $30,000 a year.
Can't have all your money in anything, right? Any one thing.
You got about $30,000. We talked about if you wanted income immediately from the 4 different kind of annuities, ranged about $5,500 to $5,800, up to $6,000 immediate. But if you could defer the income 5 years, it was $7,500 on a variable annuity, $87.98, almost $88,000 on a per million on a index annuity, and a SPIA was $8,000. Now remember, a SPIA is a single premium immediate annuity. That's the old type. That's the one all of the people say the only kind of annuity you should do.
Right.
And now wait a minute. If I get to keep my money and it grows, my heirs get it, and I can change my mind, why wouldn't I take $8,800 over $8,000?
That's right.
Doesn't make sense. But they don't understand how they work. Now let's defer 10 years. This is where the gold mine is.
Sweet spot.
All right, you put in $1 million, and we give you $108,000 a year in a variable annuity. Not bad. I'm going to give you $143,000 a year, guaranteed the rest of your life, in an index annuity. Now the SPIA again, the old type, the $11,000 a year. Who would take less income and lose all your principal? Nobody, right? That's why the index annuities are so popular. It has nothing to do with commission. 1% a year on a growing asset is way more than 5 to 7% on an annuity.
That's right.
It's just
that the client doesn't pay for.
That's right. And so think about it. Wait a minute. I put in $1 million. I'm going to get $140,000 a year. But the only way to know that is if you run all of them. I don't know one advisor at your big firms that runs more than 2, maybe 3. There's 150 just index annuities. There's another 100-something variable annuities. Yep. And there's dozens and dozens of immediate annuities. Well, we do here at McClure Capital, we run them all. So the real reason why people want annuities the last 10 or 20 years has nothing to do with fees or anything. It has to do with, I need more income than 20 or 30 grand per million. That's really what it is. And I'm worried about, what if interest rates go down as I'm already retired and I've planned on getting $30,000 a year, but I only get $15,000 a year after inflation has eaten me up for 15 years.
And we even have
they don't have to worry about that.
Another case, to give a perfect example. Victor's adding his 16-year-old son to his insurance. And
that was a joy.
Yeah, the first broker runs a number, takes 15 minutes, runs the whole deal, and comes back with an extra $5,000 or
$480 a month.
For the additional person. And Victor's beside himself, and he calls someone else up and runs the numbers. The guy actually spends about a day running all the numbers and all the
That's
company, and how much did he save?
It was $240 instead of $500, but saved me $100 on another one, so it was only $100-something bucks to add a 16-year-old with a brand new car.
And it's
Fantastic.
the same. And the point I'm trying to make is it's the same as what we're talking about here.
That's right.
If they don't offer it, they're not going to give you those comparisons. If they don't believe in it, they're not going to run those comparisons. Or if they're a little bit lazy, they just run the brief
or
stuff.
they don't
and
have access to
what they
them.
know to. That's right.
The big firms only have access to their contracts, and they're all contracted with very few carriers.
Now, on the
We have all of them.
On the index annuities, they average somewhere between 4.5% and 7% as far as the rate of return. When you're in the income stream, you can stop it, you can access your money, or you can turn it back on. You're not handcuffed. When you pass away, or you and your wife pass away, the bucket of money is still there. It's there for your heirs. While you're in the income stream each year, we choose the options on how the interest is credited, and it makes money every single year that you're withdrawing. Most of the other assets here we're talking about don't.
Now think about it. You got $5 million, right? You can take all $5 million to get $100,000 a year, or you can take $1 million to get $140,000 a year. Which one's more attractive? That's what you got to ask yourself. Even if I'm a person that has a lot of money, I have millions and millions of dollars, I can get so much income per dollar for a small piece. Remember your 3-bucket theory. The most restrictive bucket is going to be the income bucket because you got to live on it. But I can put the least amount in it if I get the most income per dollar out of a product or an investment. And so that's why we use them for the income side, because we can put less in it. Every time, how many times have you had somebody where you give them a quote and they go, well, this other person, now he wants to show them an annuity. It never competes. Why does it never compete? It's impossible to compete with a quote we've done because we've already ran every one of them.
That's right.
We know the top 5, and we're going to show you. Here's 1 through 5. I had somebody go, no, he said it's the best by far. And I go, well, let's look at it. We ran the numbers, put it on there. It was numbered like 46. I go, well, 46 isn't 1 to 5. I go, that's not bad. That's at least in the top half.
And when they finally give up and surrender, they say, oh, well, I can do that for you.
That's right. I'll do that same one.
Yeah, I'll do that for you.
Remember, we had that saying, if they didn't bring it to you, they only brought you a solution because they're about to lose your business. That's not somebody that's forward-looking at your thing. They're just going along there collecting their fees and not paying attention. Or because if you told them, hey, I don't want market risk, and they just put you in more stocks. I don't care what you are. If the stocks are stocks. I love stocks, but there's risk in it. Look at the last few months.
I know.
It's crazy risk in the thing.
Absolutely.
And there's nothing wrong with that. I've got a piece of my money that I'm willing to risk, knowing that it's going to go crazy. But when I get close to retirement, am I going to want to risk less? Yeah, a lot less. And it just makes sense.
That's absolutely.
Well, that's our show, folks. I want to thank everyone for listening to Common Sense Investing Show today. And I hope you had a great 2018. We had a great 2018 bringing it to you. Don't hesitate to call us if you have any questions at 972-715-2424. Again, 972-715-2424. I'm Victor McClure. For Guy Allert, we always appreciate your time.
The preceding show is paid for by McClure Capital and is for informational purposes only and not a solicitation or representation of any particular investment, product, or service. Any views and opinions do not constitute financial, legal, or tax advice. Consult with your appropriate professionals before making any investment or savings decisions. Always consider your risk tolerance, time horizon, and objectives in making any financial decisions. There is never any guarantee of future success or performance.